right, good morning and welcome to the 2020 year-end tax planning webinar. My name is Steve Boisvert and I'm a tax manager at GRF CPAs Advisors. I'll be today's moderator. I'd like to start off today with some quick housekeeping items and explain what you'll need to do in order to earn CPE credit. Participants seeking CPE credit today must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. So you'll be asked to recall these words in the order that they are given in order to receive credit. So please write down the CPE words and when they're given, and keep them until you receive your CPE credit. They won't be provided twice. If you have any technical questions or issues during today's webinar, please use the questions function to speak with our webinar administrator for assistance. The slide deck and recording from today's webinar will be available for download at the link shown here. And technical support and CPE questions can be addressed to Nathan McKelveen at nmckelveen@grfcpa.com. Today's learning objective is to provide attendees with a better understanding of how you should position your assets to get the best tax advantage. And our presenters for today's webinar are Troy Turner and who's the director of our tax practice here at GRF, and myself. All right, let's jump in. So today's material, here are the topics for our discussion. I'll start by discussing some individual tax rules with you that I think will be helpful. Troy will talk about business tax, share some ways to increase income, which should be interesting because normally, when we're talking about tax considerations, we're looking for ways to decrease income. So that should be an interesting discussion. And then the PPP considerations, any paycheck protection program stuff. And we'll finish up with potential changes that the Biden administration could enact. So here we go. We have an updated tax bracket slide. And what this slide is really meant to show you is the changes to the brackets that there will be in 2020. Because these are tax brackets, you really need to consider not just your AGI, but also the deductions that you're allowed to take in order to arrive at taxable income. Now, a quick note about tax brackets. I often get the question, Steve, I'm a married individual. My employer wants to give me a raise. And really, that's a good thing. But I'm afraid that I'm going to jump into a higher tax bracket, and won't that higher tax bracket end up resulting in additional income tax? Jen, I think you're not muted if you want to mute. So that's a good question. And the answer is no, it won't work against you. And the reason that it's not going to work against you is that you're taxed at your average effective tax rate. And what does that really mean? It simply means that your dollars are taxed in each bracket at the rate in that bracket. So your taxable income from $0 to $19,750, if you're married filing joint, you can see that in the third column, is taxed at 10%. And the taxable income from $19,751 to $80,250, if you're married filing joint, is taxed at 10% or 12%. And you can see that, et cetera, et cetera. So therefore, if you're going to earn, say, $171,050 in 2020, only say your income increases by $5,000 because your employer is giving you a $5,000 bonus. Only the additional amount over the $171,051 will be taxed at 24%. The rest will be taxed at the brackets as they're laid out. So, you're not jumping up into a higher tax bracket. I mean, you're not paying 24% tax on the entire 175,000. It would just be on the 400 or 4,000 and change that you would have there. So that's just one of the misnomers that you hear a lot with tax brackets. Moving on to slide 8 here, the Congress, I guess, has enabled inflation adjustments for these standard deductions. And so these are the new standard deductions for married filing joint, head of household, and single individuals for the standard deduction. You can see they've flexed upward a little bit, not a lot. I think it was about $400 for the married filing joint. And you know, what you really need to do when you're considering the standard deduction, the best thing to do is to total up your current year itemized deductions, determine if you have more itemized deductions in the current year than the standard deduction, and we can get into some tax planning for the interplay of these two options in the upcoming slides. So if we can go to the next slide. You'll see itemized deductions. If you take a look at your Schedule A on your tax return, you'll often see the deductions in this order. You'll see medical expenses, followed by state and local taxes, followed by mortgage interest, followed by charitable contributions. And if we take these one by one, we often see medical deductions with folks that are using assisted living facilities. Because of the high cost of these facilities, they can go $50,000 to $100,000 per year. And the rule for being able to deduct medical expenses is that you can deduct unreimbursed medical expenses that exceed the 7.5% floor. So if we do some simple math here, say your adjusted gross income is $100,000. The medical deduction threshold would be 7.5% of your adjusted gross income, in this case, $7,500. If you have unreimbursed medical expenses of $7,501, then you may include $1 on your Schedule A as your medical deduction. Listen, in order to take the $1, you also have to have other itemized deductions to get you over the standard deduction threshold. And you know, we saw that on the last slide, the various standard deduction amounts. The state and local, you can go back, Nathan, one slide. The state and local taxes are still capped at $10,000. State and local taxes include things like real estate taxes, personal property taxes, state income taxes, local taxes. If you had $20,000 of state and local taxes, you can only deduct a maximum of $10,000. And this is one of those topics that during the Tax Cuts and Jobs Act was talked about quite a bit, especially for high income tax states. Mortgage interest. This is typically the largest itemized deduction you can take. If your mortgage originated prior to December 15th, 2017, the cap is $1 million on the deductible loan size. If your loan originated after December 15th, 2017, the cap is $750,000. So for an easy example, we could say that the taxpayer has an average mortgage of $1.5 million for 2020. The way that you would do the calculation is that, say the mortgage interest on that loan was $30,000. If you take $1 million divided by 1.5 million, you'd come up with 2/3. So therefore 2/3 of that $30,000 of mortgage interest would be deductible. In this case, $20,000. Now, if the loan originated after December 15th, 2017, it would be $750 divided by 1.5 million, which would be 50% of the $30,000 mortgage interest, resulting in a deductible portion of $15,000. A quick note on home equity lines of credit, or HELOCs as they're sometimes called. Interest on these is deductible as long as they are used for buying, building, or fixing up a taxpayer's residence. So again, a quick example, say I've purchased a house in 2018 and the value of the house has increased through 2020. And I decide, I'd really like to put a pool in my backyard. So I know I've got equity in the house. I'll go to the bank and see if they're willing to give me a loan. So you go to the bank, they say, we'll give you $100,000. And you go to the backyard, you pick a contractor and they say, okay, $50,000 to build the pool in your backyard. If I then, with the other $50,000, keep seeing my neighbor's Mercedes and I say, I'd really like to buy a Mercedes as well. You spend $50,000 on a car, only 50% of the interest on that $100,000 loan is going to be deductible, because $50,000 was spent to fix up or build something on your property that's connected with the house, and 50% was used on a car, so not deductible. All right, Nathan, we can go to the next slide now. All right, so on the last slide, you would probably notice that the final charitable, or the final itemized deduction that was not included on there was charitable contributions. Charitable contributions in 2020 are 100% deductible, and there's no limitation on cash contributions. In the 30% AGI limitation on contributed stock remains though, and the 50% limitation on non-cash contributions like clothing, household items, you know, the kind of stuff that you give to Goodwill or Salvation Army, those amounts do remain. So if you total up your itemized deductions, and to date, you're essentially at break even on your itemized and standard deductions total, you can use a technique where you can bunch charitable contributions in 1 year. And that you would typically pay over 2 years. Now, because you're a cash basis taxpayer, you can only take a contribution that's paid in that tax year. So in 2020, for example, you couldn't take a deduction that or say you've made a contribution in 2021, you can't take that deduction in 2020. But if, say, throughout the year you are contributing money to your charity of choice, maybe your school or your church, or, you know, whatever it is that you like to support, and you get to the end of the year and you look at your total itemized deductions and it's just past the standard deduction amount, you may want to consider making the 2021 charitable contribution in 2020, whatever you would expect to pay. And I've got a quick example here that can kind of illustrate some of the tax savings you could see. So in our example, we've got $10,000 for state tax, property taxes, say, mortgage interest of $10,000 and charitable contributions of $5,000. The total is $25,000, and you can see it's just above our standard deduction of $24,800. The tax savings that you get from your itemized deductions in this case is $5,000. We're using a made-up tax rate of 20%. 2021, you can see it's the exact same scenario. So you've got total tax savings over 2 years of $10,000. If you want to go to the next slide, Nathan, I can show you what happens when you bunch. So in this case, same scenario, property tax, mortgage interest, the same, but instead of making your $5,000 charitable contribution in 2021, you make it in 2020. So you have $30,000 of total itemized deductions in 2020. That's greater than the $24,800 standard deduction. So you're going to always take the higher amount. You'd have tax savings in 2020 of $6,000. In 2021, you don't have the charitable contribution anymore. You don't have enough itemized deductions to itemize. So you've taken the standard deduction in this case of $24,800, a difference of $4,800. So if you look at the tax savings from 2020, you have $6,000, 2021, you have $4,960 for a total of $10,960. On the previous slide, we have tax savings of $10,000. So we've got a difference of $960. Not a huge tax savings, but maybe something worth considering. Just a quick disclaimer on bunching charitable contributions. It really works differently based on your home state. So if this planning strategy interests you, please reach out to us and we can run an analysis on your specific tax situation, because we wouldn't want you to have a favorable federal tax result and an unfavorable state tax result that basically results in the same total tax. You know, I live in Florida, so this would work better for me because there's no state income tax. But if you live in, say, DC or Maryland or New York, it may be a little bit different result. As I mentioned earlier, the charitable cash contributions, the AGI limitation was increased to 100% in 2020 through the CARES Act legislation. And I'll get into an example in a second that should explain the AGI limitation and how it works. And the good news is that there's still no limitation on itemized deductions. This was done away with in the Tax Cuts and Jobs Act. The P's limitation was removed, so you don't have to worry about that anymore. All right, so let's discuss a couple options that you have in tax planning, in the tax planning arena with capital gains and charity. And this works best if the taxpayer is already charitably minded, they're already planning on contributing a sum of money to a university or whatever of their choice. And the topic is donor advised funds. And if you haven't heard of these are kind of an interesting tax planning vehicle. Most of the large brokerages have them. The ones that we see most commonly would be Fidelity, Schwab. And so here's how they work. If you have if you have a stock that's been sitting in a brokerage account for a number of years and has substantial capital gain, you can kind of layer these two tax laws together to produce a substantial tax savings. If you want to go to the next slide here. So in our example, we're going to have a taxpayer who's married filing joint. They have adjusted gross income of $700,000, and that includes a $50,000 gain on the sale of Apple stock. So, you know, in our made up example here, we're going to say the taxpayer purchased the stock in 2010 for $50,000. That's their basis. And they are planning on selling it in 2020 for $100,000. They're going to make a $50,000 gain. So if you simply sold the stock in 2020, you'd recognize a gain on the sale of the stock of $100,000 minus $50,000, a total of $50,000. And because the taxpayer is in the top tax bracket, they would pay a capital gains tax, a long-term capital gains tax of 20% plus the net investment tax of 3.8%. So the total tax on the sale of that stock would be $11,900. If the client determines they want to contribute $100,000 to a charity with, say, ordinary income that they've already paid tax on, like wages, you get the full deduction this year, but you would not be able to avoid recognizing the gain on the sale of the Apple stock. Go to the next slide here. So if we put the two tax laws together, here's how we'd achieve the following. So because we're contributing our stock, the AGI is now $650,000, your adjusted gross income. Instead of $700,000, we don't have to recognize the gain on the sale of the stock. So we have $650,000 adjusted gross income. The contributed capital gains have a 30% AGI limitation. So 30% AGI limitation simply means if we take $650,000, which is their adjusted gross income this year, times 30%, the max charitable contribution they can deduct in 2020 is $195,000. If they contributed $200,000, they could deduct $195,000 this year and $5,000 in 2021. But in this case, we're only contributing $100,000, so our contribution is not going to be limited. And by contributing your $100,000 to a donor advised fund, you reduce your taxable income yet again by $550,000. And the big point here is that you avoid the recognition of the gain on the sale of the Apple stock. So your total tax changes from, say your taxable income was $700,000, the tax would be $216,289 to $171,977, which is the tax on $550,000. So your total tax savings on the contribution of the Apple stock to your to the donor advised fund is $44,312, which is basically 44 cents on the dollar. That's really good tax savings in the situation. So if instead of contributing the stock with the appreciated value, you simply made $100,000 charitable contribution from your ordinary income after tax savings, you would only save $32,000, $32,412. So by using the stock contribution, you've saved yourself $11,900, not having to pick up that gain. That's what, 32 cents on the dollar. It's not as good as savings. So another cool feature of the donor advised fund is that it allows you to take the deduction in the year of contribution, which in this case is 2020. But the donor is allowed to advise on the use of the funds for future tax years. So maybe you know for a fact that you want to give the University of Maryland $50,000. You're not really sure how you want to use the other $50,000. Well, you can advise that you'd like to use that that contribution for this year for $50,000 to Maryland, but in the succeeding years of 2021, 2022, you have the option to say, you know, and I'd also like to contribute this amount to my church or my synagogue or whatever. If you're interested in this tax planning option, we can put you in touch with some reputable brokerages that do have donor advised funds. And as always, you know, before you do something like this, check in with us. We can run some analysis on your current 2020 tax situation and help you decide whether or not this is the best course of action. Just some other ways to reduce your taxes. Use your year-end bonus to max out your 401k or 403b. If you've been contributing your retirement plan throughout the year, but you still haven't maxed out the amount you can contribute to it, if your firm or your company is making a year-end bonus, you can use that to send that to your 401k to max that out. That's a way that you don't have to pick up the tax on that income this year, and you can defer it until you remove the funds from your 401k or your 403b. Because of the CARES Act, you do not have to take a required minimum distribution this year. That's one of the big things that came out of the CARES Act legislation. Hold investments for more than 1 year before selling. That's just to get long-term capital gain treatment. If you're in a higher tax bracket and you sell a short-term stock, it's going to be taxed at your ordinary income rates. If you hold the stock for more than a year, the best rate on long-term cap gains is 15%. And if you're in the top tax bracket is 20% with a 3.8% net investment tax, which came through the Affordable Care Act legislation. You can sell investments at a loss to offset capital gains. This is the one where your financial advisor calls you and says, hey, you've got a lot of capital gains this year. We could harvest some losses to minimize those capital gains, which is my favorite way of saying these investments lost money and putting a nice spin on it. You can accelerate your medical expenses to get over 7.5% threshold. In this case, I mean, it's maybe elective surgeries. I know a lot of hospitals are not doing elective surgery right now just because of the COVID stuff. But that's potentially an option for you. You can contribute to your IRA, which would be deductible only under certain circumstances. But even if you contribute to your IRA and it's not deductible, those non-deductible contributions do act as basis that will help to reduce some of the tax impact when you withdraw that cash in retirement. And then, as always, don't miss out on your common tax credits. The first one's near and dear to my heart. I've got 4 kids. So when they updated the child tax credit from $1,000 to $2,000, that was a great day in my house. The child care credit is, you know, after school activities, maybe you have a nanny. The max credit on that is $1,200. But that's one that's always kind of discussed in anytime there's a potential tax law change, maybe increasing the child care tax credit. And then education. This one's subject to phase out, but maybe you're having a down income year. You had a kid in college, maybe you went to college yourself. The lifetime learning credit and the American Opportunity credits are good credits that you can look into. And credits are huge because they're dollar for dollar reduction in your tax. You know, the best deduction that you can take was, I mean, we've got to 44% on that donor advised fund. So that's 44 cents on the dollar. A tax credit is a dollar for dollar reduction. So those are the best thing you can get on your tax return. And then some final points here in the individual tax realm. The CARES Act allows for a $300 charitable deduction above the line, and this simply means that everybody can take at least $300 for charitable deductions if you've contributed money to a charity, even if you're not itemizing. So maybe you're taking the standard deduction. It's not much, but maybe 50 to 100 bucks in tax savings there for the charitable contribution. And then the basic estate gift exclusion amount in the GST exemption has increased to $11,580,000 for 2020. Most estates will not be taxable under that amount, especially if it's a married couple, the spouse dies, they file an estate tax return. You can get portability of that $11,580,000 to the surviving spouse. So the total would be what, 23 million and some change. If your estate's not over 23 million, you're not going to have an estate issue. But this is something to keep an eye on, especially with election season here. If in Georgia, the state runoff elections go to Republicans, you'll see divided government with the Biden administration and the Senate being Republican. So you would get that interplay there. It's less likely for there to be tax changes in a divided government like that. Troy's going to talk a little bit more about some of this, but I think one of the potential changes that Biden was looking to make was to drop the exemption to about $1 million. So that would mean there would be quite a few more people that could fall into that estate tax. Looks like we've reached our first polling question for the day. Which statement best describes where you currently stand with your 2020 tax planning? I've already done my planning for 2020. B, I'm interested in planning, but I've not begun the process. And C, I do not plan on doing any planning this year. And we also have our first CPE word. So please take a moment while folks are writing those or taking that poll. Let's see, the first CPE word for today is investment. If you want to receive CPE credit, please jot these words down because you will need them for the survey following the webinar. Again, the first CPE word is investment, I-N-V-E-S-T-M-E-N-T. It looks like our poll results here are 47% have already done their planning for 2020, 38% are interested, have not begun the process, and 15% are not going to do any planning this year.
Thank you, Steve, for covering all that good information on the individual side. Hello, everybody. Thank you for joining us today to cover some topics that are business related. Although the first one I'm going to cover, the qualified business income deduction, is actually taken on your personal tax return. But in order to take it, you must have business income that is reported directly on your return or flows to your return from a pass-through business entity like a partnership or S corporation. So I'm not going to get too heavy into this discussion. I'm going to try to run through it pretty quickly. We've covered the last couple of years, but it is a big deduction and one we want to make sure people don't miss. And to the extent you can do some planning around it, we want to make sure you do that. And obviously, if you've started a business this year, then this will be the first time that you qualify to take this deduction. And it is a freebie in the sense that you don't have to actually outlay any cash to get the deduction, which is different than just about any other deduction you can take on your return. Usually you got to spend money to take a deduction, but this one is not like that. So again, it came out in the 2018 tax law, and there really aren't any changes here, but we're just going to run through the how the deduction works real quick. So again, in order to get the deduction, you must have qualified business income on your return, and that's generally from operating a sole proprietorship, which is where you have business income and expenses on Schedule C, followed with your personal return. You could be partner in a partnership and receive a K-1, or a member of an LLC and get a K-1 from that, or a shareholder in an S corporation and get a K-1 from your S corp. You could have a rental property with net income. It's important to note that in order to take the deduction where you're getting income from a flow-through entity, the K-1 must have the necessary information on it in order for you to take the deduction. So the deduction itself is 20% of your qualified business income. It's the lesser of 20% of your qualified business income, or 20% of your taxable income, after you make adjustments by removing capital gains and losses. So it's a lower of those two amounts. There are further restrictions when you hit certain income thresholds. So it's important to note that if you have qualified business income, and if you are a married taxpayer and your taxable income is below $326,600, then you qualify to take the deduction. If you file any other tax return, whether it's married filing separate, single, or head of household, and your taxable income is $163,300 or below, then you qualify to take the deduction. There's no other complications. You have qualified business income and your income levels are below these amounts, then you get the deduction. It's as simple as that. And we'll go over the restrictions on the next couple of slides. But I want to point out here for rental real estate can qualify, doesn't only. It depends on whether or not the activity rises to the level of being considered a trade or business, or that's in a general sense. There's a safe harbor that they put into law where they've have some provisions where if you put 250 hours in operating your rental activity, then you qualify, that activity qualifies as qualified business income. And then if it's a self-rental situation where you, let's say, have a business and you own your building and you rent to yourself, then the rental income qualifies in that case. The IRS came out with some forms that we use to deal with that on your tax return, and they're listed here, and the IRS has an FAQ out on their website that answers more questions on this. So the first restriction, which we see, I think most often, that knocks people out of being able to get this deduction, is that a lot of our clients are specified service businesses. So if you're a specified service business and your income is above the thresholds we just discussed, then your ability to take the deduction will phase out or be completely eliminated. So it's important to know what types of businesses do not qualify to take the deduction. So those are generally your personal service businesses, professional personal services, so health and accounting, your law firms, actuarial sciences, athletes, financial planning. You can see it here. In the broad category that we run into the most is consulting. A lot of our clients have consulting practices in one way or another. So we've got the definition there. They came out with some additional guidance on what is meant by consulting, so you can see that. I won't read that to you. But so if you're a specified service business, then that could keep you from qualifying for the deduction, again, if you're above the income thresholds. So if you're not a specified service business, so you're a qualifying business, then you could be kept from getting the deduction, or your deduction could be reduced depending on the level of wages that your company pays that are allocated to you. And so basically the deduction can be further reduced by 50% of the wages reported in box 5. Box 5 is Medicare by the company. They're allocated to you. So for example, if you own half the business, so you're allocated half of the wages. So in this case, your allocation for this purpose would be 25%, so half of the half. So if 25% of the wages paid by your business is lower than the qualified business income deduction that's already been calculated, then you would take a deduction that's based on that lower amount, that's based on the wage number that's lower. Or for those that aren't wage heavy, but maybe the business is heavily capitalized, so it's maybe in the real estate area, then you can use an amount that's 25% of W-2 wages plus 2.5% of your unadjusted basis of depreciable assets. So you take those two numbers, add them together, and if that's lower than, if your allocated amount is lower than the qualified business income deduction that's already been calculated, then you'd use the lower amount as the actual deduction. So now, again, if your taxable income is below those amounts we've already discussed, the 326 and the 163, you don't have to deal with these additional complications and reductions. If you're on a joint return and you are a specified service business, or you do have a wage or asset limitation, then you have to deal with those in a phase out area of 100,000 on a joint return. So between 326 and 426, your deduction phases out. On an individual or a non-joint return, I should say, there's a $50,000 phase out. So between 163 and 213, your ability to get deduction phases out there. And then once you get above the 426 and the 213, if you have issues related to not having any wages, say for example, if you have zero wages or zero assets, or you're a specified service, then you can't get the deduction at all. So again, there's an item here that's, your wages have to be reported to Social Security on time in order for them to count in the calculation. So quickly, there's an interplay with S Corps. S Corp businesses, we always deal with kind of a minimum compensation amount for the business owners. So the business owner, there's the interplay between how much to take out in salary and how much to flow through on the K-1. Well, what you pay yourself in salary doesn't qualify for the deduction, so it's only what flows out on the K-1 that qualifies. But then there's the interplay with the wage limitations. So if you have not enough wages because of your income level, you have to deal with that. So there's some planning really there on the S Corp side that you have to look at on how much, owner comp is taken to make sure you're maximizing your available qualified business income deduction. So reach out to us on that. I don't want to get any more detail there, but just so we can help, to make sure you're maximizing that. On the partnership LLC side, if you're mainly paid through guaranteed payments, they're not qualified business income. So it's better to get a profit allocation, an allocation of the net income to you on line 1 of your K-1 versus a guaranteed payment, because the guaranteed payments don't qualify. So you may need to look at your partnership agreement to change that, so that your guaranteed payments somehow, are part of a formula where you get the appropriate amount of profit allocation instead. Real estate investment trust, REIT dividends qualify, and so do publicly traded partnership income qualifies as qualified business income. It's important to note that foreign income does not qualify, so it has to be US-based income. And qualified business income, if you have multiple businesses, you figure out your deduction on a business by business basis, and then you add them together. So if you have a qualified business loss that exceeds all of your qualified business income amounts, then that would wipe it out and then the loss would carry over.
All right, we've reached our second polling question. Do you expect to utilize the QBID, qualified business income deduction, on your 2020 tax return? A, yes, I have already factored it in to my tax planning. B, how do I find it? How if I qualify? And I do not expect to utilize the deduction. Let's see. So please take a moment now to answer that. While the participants are submitting their answers, I'll provide the second CPE word. The second CPE word is dividend. If you want to receive CPE credit, please jot these words down. Again, the second word is dividend, D-I-V-I-D-E-N-D.
Okay, looks like most of the people on the call today are not expecting to take that deduction. It's a little surprising. I would expect that to be a little bit higher, but that's fine. We'll move on here. Okay, I just want to touch on depreciation. It's always a really big deduction for most of our clients, and there's very generous provisions in the law. So bonus depreciation for 2020 is 100%. So basically, you buy any new or used property that has a useful life in the 3, 5, 7, 10, 15, or 20-year classifications, you can basically write off 100% of it, of the cost of that item. And you can utilize bonus depreciation to actually create a loss for that business. Section 179 deduction's been around for a long time. I think when I started in the profession, it was like only $25,000. So now it's $1,040,000. So a significant difference since then. Your ability to take 179, then that's an election. Whereas bonus depreciation is automatic and you elect out of it if you don't want to take it. To take the 179 deduction, you elect into it. So there's a difference there. The limit's the 1,040,000, and if you buy a ton of property, more than 2.6 million, then your ability to take 179 goes away. But again, because bonus depreciation is in play at 100%, most people just usually utilize the bonus depreciation. One thing to look at would be this at the state level. States handle bonus depreciation and 179 deduction limits differently. So there could be a case where a state would allow the $1 million in 179, but not the 100% bonus. So it could make sense to use one or the other based on how the state handles it. And again, 179 applies to used or new property. One difference compared to bonus is you can't create a loss with a 179 deduction. Any additional 179 deduction just carries over to be used in a future year. So in 2018, with the Tax Cuts and Jobs Act, prior to that, it used to be that if you had a business loss and you met the criteria at the bottom of the screen there, the unhighlighted ones, basis, you had basis, you were at risk. You were at risk for the loss under 465. It was an active trade or business. It wasn't a passive activity. You met those 3 criteria, then you could take the loss. You could take all of it. Didn't matter what the amount was. If it created a overall loss in your return that was an NOL, then you could carry that forward or back. So in 2018, they added a new provision in 461 that limited your ability to take those business losses on your personal return in excess of 500,000 against other income on a married filing joint return, and in excess of 250,000 on all other returns. So basically, they put in this limitation on business losses, aggregate business losses, to offset other income on your personal return, and they put that in play in 2018. The CARES Act has suspended that limitation for tax years 2018, 2019, and 2020. So first off, if you had a limitation in 2018, then you'd be required to go back and amend that return to remove it and see if it creates an NOL, or if nothing else, creates a refund on your return and get that refund. This was put in place in the CARES Act came out in March of this year. So if you had not filed your return, you've probably already made this adjustment and dealt with this. But if you had filed early for 2019 and used a carryover loss from 18 or had a loss limitation from 461, you might need to amend your return for that also. And then it's just something to keep in mind for 2020 that this limit's gone. So other 2020 and recent tax law change reminders. A big one in the CARES Act was the net operating losses. There's a change there. So in 2018, the tax law there eliminated carrybacks and created an 80% limitation for carryovers. So the CARES Act rolls that back and basically says for 2018, 19, and 20, if you have an NOL in any of those years, you can carry back that loss 5 years and then carry that forward. And for those years, there's no limitation on how much you can take to zero out your income. So there's no 80% limitation. You can take 100% of the NOL to the extent you need to offset your income. So again, with that, you want to look back and see if you need to go back and amend a return where you had an NOL in 18 or 19, and may want to carry that back and get some taxes that you paid in earlier years. So these are provisions mainly to just help businesses that are struggling and need to get some cash infused into their business to keep operating, be able to do that and get that 5-year carryback. Nathan, you go back to the previous slide real quick. Just some reminders in 2018 law for C Corps, you could be on the cash basis up to 25 million in revenue. Used to be 5 million. So in 2018, they increased the revenue test on that to 25 million. So it's your C Corp and want to be on the cash basis, then that's your revenue threshold. Also under the CARES Act, charitable contributions made by C Corps used to be limited to 10% of your taxable income, and they increased that limit to 25% of taxable income. And they did a fix in the CARES Act to if you had 15-year property, the 2018 law made it so it didn't qualify for bonus depreciation, but that was an error, so they fixed that and it now qualifies. So you may need to go back and fix your 2018 or 2019 returns if you didn't bonus a 15-year property and wanted to. Then you could need to go back and you can make that correction, and there's we can help with that. Other ways to reduce business-related income. So on your personal return, if you get a K-1 and you have some unreimbursed business expenses that the partnership or S Corp didn't pay directly and are not going to reimburse you for, you can deduct them on your personal return against your K-1 income on a supplemental business expense form. You could potentially contribute to your SEP IRA, so making a retirement contribution, based on your business income is always a good idea. You can take the home office deduction. Now, one thing on the home office deduction is that if you're an employee, it used to be that you could qualify for a home office deduction and report that on Schedule A. So the reason Steve didn't cover that in his section is because the 2018 law removed miscellaneous itemized deductions from itemized deductions altogether, and a home office deduction for an employee was a miscellaneous itemized deduction. So there's no ability to do that as an employee any longer. Well, one thing you'd want to do as an employee would be to look to see if your employer would reimburse you for some of your home office expenses, tax-free under an accountable plan. But unfortunately, there's no more home office deduction at the end for employees. If you're self-employed, so if you have a Schedule C, or if you get a K-1 and you use a portion of your house on a regular and continuous basis for work, then you can take a home office deduction, which is generally a percentage of your utilities and repairs and maintenance and insurance, other costs to operate your home. So that's always something good to look at. And then, deducting business mileage on your personal automobile, make sure you're tracking that. And I'm not sure what the mileage rate is for 2020. It's usually around 55 cents a mile, somewhere in that neighborhood. So you want to make sure you're tracking that so you can get that deduction.
We've come to our third polling question of the day. Which statement best describes how tax laws impact your behavior? A, the potential tax outcome is at the forefront of my mind. B, I only think about the impact of significant events. And C, it doesn't. Why worry about them? So please take a moment here now to answer. And while participants are answering, our final CPE word of the day is revenue, REVENUE, revenue.
Okay, we've got the results. I guess that's as expected, that 75% of you only really think about the tax impact of things when there's significant changes. So that makes sense. And that's generally what we see. So I want to touch on just a couple ways to increase income. So often, we'll have clients that just have a down year, and of course, with COVID, that the prevalence of business clients having down years is obviously way increased. So So when you have a down year, you want to look at ways to not lose the benefit of the deductions you do have. Now, if they're business deductions and they create an NOL, then you know they're not lost. I mean, you can carry that again. We just talked about the fact that you can carry that back 5 years and get some cash back, or you can you know, carry that forward to use it against you know, future income to lower your taxes. But things that are lost are your itemized deductions. So if you normally have a lot of itemized deductions, you know, then those things don't carry over. So so you want to look at ways to you can bring enough income on your return that makes sure you're maximizing the deductions you do have to offset those so that they're not lost. So the benefit of those deductions aren't lost. So one way to do that is to do a Roth conversion. So if you have a traditional IRA where when you pull the money out at retirement, you know, all the money you pull out is going to be taxable. One of the benefits of the Roth is that, you know, money that's in there comes out tax-free at retirement. But money going in on a regular contribution is not a deduction, but there is a provision where you can convert traditional IRA money to a Roth and then you pay the income. You report the conversion income the year you do the conversion. So it's a way to just create some income, offset that income against deductions you already have. So it's kind of a net, you know, zero tax situation. And now you've got some income in, or some money in your Roth that's going to come out tax-free at retirement that would otherwise come out as taxable if you left it in your traditional IRA. And you don't have to convert your entire IRA. So this is very flexible in the sense you can just pick an amount in your Roth to convert. And you can do a little each year or just to do this whenever you have, again, a low income year where either you're going to have a loss or you're in a low bracket. You can always sell investments where you have unrealized gains to create capital gain. And then there's a special provision that was put in the COVID law where if you were a member of your household who've been affected by COVID, that you could take up to $100,000 out of your qualified retirement plan by the end of this year. And not, so if you're under 59 and a half, you would not pay the 10% early distribution penalty. And this is on a taxpayer by taxpayer basis. So on a joint return, you could each take out 100,000. And what's really neat about this provision, not just the fact that you don't pay the penalty, but the fact that you can spread the income hit over 3 years. So you would pick up a third of the income in 2020, a third in 2021, and a third in 2022. So you can make that election to do the spread. And if you can even put the money back in to your IRA account, let's say you took it all out of your IRA account, you could put the full 100,000 back in your IRA by the third anniversary of the date you took it out. And then none of it's taxable. So it becomes a qualified rollover. So normally you can do rollovers and you have 60 days to do a rollover if you take money out of your IRA and not pay tax on it. But in this provision, you actually have 3 years to put the money back in. And if you've, wait till year 3 and you've picked up some of the income in year 1 or 2, then you'd have to go back and amend to remove that income. So there'd be a little bit of hassle there, but just the idea that you could take this out and, cover like a short-term cash flow issue, and then put it back 3 years later and not pay any tax on it is really good provision. And again, you'd have to take that money out by the end of 2020. So just to touch on real quick, I know we're running out of time. We want to leave a couple minutes for questions. PPP loan. So for our business clients out there that have a PPP loan, the way it currently works in law is that the assumption is you're going to apply for forgiveness and that you'll receive it. So when your loan is forgiven, the loan forgiveness itself is not income, but the IRS clarified earlier this year that the expenses that are paid with the forgiven loan proceeds cannot be deducted. So it really operates as if you got to take the deductions and pick up the loan forgiveness as income. So it really kind of operates as income. So I just want to make sure that everyone understands that if you have forgiveness, that you're going to have, at least under the current rules, unless they come out and change them, which is a possibility, that you'd have to, you can't deduct the expenses that you use to qualify for the forgiveness. So the question we have right now, we're waiting on guidance, is, those expenses happened and they were paid for in 2020, but your forgiveness most likely won't occur until 2021. Even if you put in an application today, the decision on that probably won't happen until next year, given the timeframes that the bank and the SBA have to make their decision. So if you have forgiveness in 2021, but you paid the expenses in 2020, then, and they don't change the rules, then where do you reduce your expenses? You reduce them in 2020 when they were actually paid, or do you reduce 2021 expenses? Again, we don't have guidance on that, but I think the safe bet is to plan for the reduction to happen in 2020, because that's when the actual expenses related to the loan happened. So, I think it's likely that could be the outcome. But again, under normal tax rules, when you have a loan forgiveness, that's whatever year that occurs is generally when you have the income event. So again, that's why everyone's looking for guidance on, where that, removal of the deduction for the expenses occurs. But again, to be safe, plan for it for 2020. And again, if you have any additional questions on that, just please reach out. So the last thing I want to cover quickly are some of the provisions that the Biden camp has put out there during their campaign. As Steve mentioned, it's still kind of up in the air on how the Senate's going to play out. I think there's, as he said, there's 2 races that are runoffs in Georgia. And if the Democrats win both of them, then there'll be a 50-50 split, I believe, in the Senate. And then the vice president has the tie-breaking vote there. But so if that were to happen, and I think the House is, it's been determined that the House is still Democratic, more than 50% Democrat. So under that scenario with a Democratic president, with Biden as president, and if you had a 50-50 Senate and the House, then it's likely that some of these things would occur. If the Senate stays majority Republican, then it would be much harder for Joe Biden's provisions to get implemented, but I think some of them probably would, because there's still moderate politicians out there, so probably some of his agenda would get passed. So he's looking to increase the top rate from 37 to 39.6. This is what it was before Trump changed it, and with in his tax act, those amounts there are where you hit the top tax bracket currently in 2020. Biden's talked about increasing taxes for taxpayers making more than $400,000, and there's various ways that he's talked about doing that. One of them is beginning to tax wages on Social Security once people hit $400,000 in wages again. So right now there's a cap on Social Security at about $137,000. So the first 137 and change is taxed, and then you aren't taxed to get on Social Security anymore. So there's a cap on it. So he's I guess, proposed creating a kind of a slot where you don't pay. So you don't pay between, say, 138 and 400, but then those people making 400 would start to pay again. So he's talked about ending the capital gains rate for people making over $1 million. So people making over $1 million wouldn't get the 23.8% rate. They pay the 39.6 plus the net investment tax on long-term capital gains if they're making over $1 million. He's talked about capping itemized deductions at 28% benefit, lifting the SALT cap on state and local tax, which Steve discussed, reintroducing the P's limitation, which Steve talked about, which is a 3% reduction in your overall itemized deductions once you hit an AGI number of a certain amount. He's talked about, as Steve mentioned, lowering the your lifetime estate and gift exemption. But more importantly, or maybe as importantly, he's talked about removing a step up in basis at death. So right now, when a person dies and they leave their assets to their heirs receive them at a stepped up basis, so at a fair market value at date of death for when they sell it. So he's talked about removing that, so they would receive it at cost, whatever the person who died, the decedent's cost, and then the people who receive and sell the assets would have to pay tax on the gain. So I think that would be hard to administer, but That's a proposal he has. And then there's some other ones here, but we're kind of out of time to cover them. One with corporate tax rate would be increased, and some other credits would change or be introduced. So now I know we're at 12 o'clock, but I don't know if we have any. I don't see any questions.
Yeah, we had a couple quick questions. I answered a couple of them in the Q&A box, but one of them was 529 plans. Do you recommend using them? And if so, what kind of considerations do you need to think about? The first one would be what state do you live in? Because the rules vary by state pretty drastically. Virginia has, I think, much more favorable 529 plan rules than does Maryland, and DC is kind of somewhere in the middle. So I would look at the state, and then also finding the correct broker to put the money in the funds that you'd like it to be in for those 529 plans. If that's something you want more information on, feel free to reach out to us. Troy, there was a question regarding the PPP. It was Judy sent in, said if I paid payroll and rent with Paycheck Protection Program, then I can't deduct those expenses. You want to take that one? Yeah.
So the way the law is written, assuming you get a 100% forgiveness on your PPP loan, then those payroll and rent costs you use to achieve your 100% forgiveness, you wouldn't be allowed to deduct those costs. So while the loan isn't taxable, the forgiveness of the loan isn't taxable, you wouldn't be allowed to take those deductions. Now, it's been stated from the beginning that people don't think that was the intent of the law. And that's why we think there's still a chance, they could come out with a provision to fix that, but they're kind of running out of time because, we're in the window where people are applying for forgiveness. But hopefully they'll make a change there and allow those deductions to be taken. But right now, the way the law is written and the way the IRS has come out and reaffirmed it is that you would not be allowed to take those deductions.
Yeah, I think the idea is to wait and see if there's an additional stimulus plan that the Congress does, and to see if they make that fix. In the new legislation, but in a lame duck session like this, it's kind of, is there a chance that we'll get stimulus done before December 31st? That's anyone's guess. And then Troy, there was one more question. Can bonus depreciation losses be applied against pension income? I think this was asked when you were discussing the topic business deductions and depreciation.
Right. Yeah. So if you buy assets and take the 100% bonus and that creates a loss on your return from that business, then you can use that loss on your 2020 return to offset other income, which would include pension income.
But you'd have to have a business, correct?
Right. So this would be, a business asset where you're actively involved in it. So there's no, passive considerations where it might be suspended. So an active trader business that you're operating, if that has a loss as a result of buying some equipment and you've taken the 100% bonus depreciation to get that loss, then you would be able to, take that loss against other income on your return. And it's not limited because they've removed that limitation under the 461 that I discussed earlier.
I think that's all the questions we have, and I think that's all the time we had. We do have some upcoming events. So, with that, we'd like to thank everyone for attending today's webinar, and we encourage you to follow us on social media at GRF CPAs and visit our website at www.grfcpa.com for upcoming events and alerts. And please remember to complete the survey that follows if you would like to earn CPE credit for attending today's webinar. Thanks for attending, and I hope you have a great day.
Thank you.